Welcome to Explainomics from MarketWatch, where we explain everything around the intersection of business, finance, and everyday life. It's tax season, so today we're going to talk about what happens to your taxes if you're a last-minute person. Well, let's say all of 2022 went by, you didn't once think about your taxes, you didn't strategize on how to minimize them, and now tax day is fast approaching and you're regretting doing nothing about your taxes last year. Well, I'm here to tell you it's not too late. There's still a lot you can do to cut last year's taxes. Keep watching. Let me show you how. The first thing you can do to cut last year's taxes is contribute now to an individual retirement account or IRA. As you may know, anything you contribute into an IRA is tax deductible. That means that it reduces your taxable income. You pay no taxes on it. You can still contribute up to the tax deadline, which this year is April 18th, for last year's IRA. And an extra hack, if you worked and your spouse didn't, you can contribute for your spouse as well in a separate IRA and reduce that portion of your taxable income as well. The max you can contribute for 2022 is $6,000 if you're below the age of 50 and $7,000 if you're above. The next thing you can do to cut last year's taxes is contribute to a health savings account for last year. Now, as you may know, a health savings account, or HSA, is a special type of account that's used for specific healthcare expenses. Every dollar you contribute to a health savings account is tax deductible. That means that it lowers your taxable income, you pay no taxes on it. There are contribution limits, which for 2022 are $3,650 for single filers and $7,300 for married filers. But the good thing for last-minute people is that you can still contribute to last year's account until the tax filing deadline, which is April 18th for 2023. And the extra benefit is if you leave the money in there and it just keeps growing and getting reinvested, you will never pay any taxes on it, and you can eventually use it to pay for healthcare expenses. The last thing you can do is use your flexible spending account, or FSA. That's a special type of account that you put money into at the beginning of the year, and then you use that money tax-free to pay for eligible healthcare expenses. As you may know, FSAs are subject to the use it or lose it rule. It means that if you fund the account, then the year goes by, you haven't spent the money, you lose it. So let's say you forgot all about it in 2022, you didn't use the account. What happens now? It's not too late. You can still use last year's funds and get reimbursed. What you need to do is find those receipts. It's okay if it's not from the special credit card that the FSA company sent you. Any type of receipt counts. Use those receipts, submit them to your FSA provider for reimbursement. And here's the extra tip. It doesn't have to be medical expenses in the strict sense of the word. A lot of people don't know that a lot of wellness expenses do qualify for reimbursement. Things like sunscreen, baby monitors, contact lenses, feminine care products, and even your weekly session with your therapist. So there you have it. Even if you procrastinated all of last year, there's still time to cut your taxes using 3 types of accounts: IRAs, HSAs, and FSAs. For more content from Explainomics and MarketWatch, don't forget to subscribe and keep watching videos on the Explainomics playlist. I'll see you next time.